Welcome to our update session on the impact of COVID-19 to entities applying IFRS. This is one of two updates that we are offering. Another session will be taking place next week related to the impacts on entities applying public sector accounting standards. Just to give you a little bit of an insight on what we're covering today versus what we'll be covering on the public sector session next week. Given we expect most of you on this call and plus some additional people will be attending the public sector session, we will be covering most of the audit issues because the audit issues are very common regardless of what gap you're applying in the public sector session. But if you have questions today for us on some assurance issues that relate to IFRS, feel free to ask, and we'll do our best to answer those questions. As far as some logistics go today, for those of you that are logged into the WebEx platform, if we are going to leave time at the end, probably around 10 minutes or so, to answer any questions that come in. So you can send your questions in using the Q&A feature. Send it to all panelists rather than sending privately so that all our panelists can see it. For those of you who did not join through the WebEx platform and who have dialed in and are following along in your own file. In your email that you received related to this, it said you can send any questions that you have to Sona Ruparelia. If you have a pen, I'm gonna write down. I'm gonna rhyme off her email address really quickly, but you should have it in that email. It is sruparelia@bdo.ca, and Sona will be helping us at the end to moderate the question and answer portion of our session. As far as the rest of the session, my name is Armand Capasciolto. I'm the National Accounting Standards Partner at BDO, and I actually had the pleasure of speaking to a number of you at the CCOLA conference in Ottawa in January, which seems like a lifetime ago with everything going on right now. And I've also had the opportunity to work with some of you on projects in the past. I'm joined today by Dave Rasmussen. Dave is one of our group technical leaders at BDO. He's responsible for our Central Canada region, which includes the Toronto area as well as much of Southern Ontario. Some of you may have also had an opportunity to work with Dave as he is the engagement quality control reviewer on a joint audit that we perform with one of your offices. So we'll do our best to stay on track and bring you through as much of the IFRS issues that we can make you aware of. So what are we going to try to cover today? We're going to focus mainly on March 31st year ends. Obviously, the public sector has a lot of March 31st year ends, so it's very relevant to you. But we will also touch upon issues that we expect to arise post March 31st. As you know, it's still the early days at March 31st, obviously, of the COVID-19 situation, and a lot of the reactions to it are happening post March 31st. Before we get into the details, I think it's really important just to kind of set a context or a tone of what we're trying to accomplish here, and really the scenario that we're facing with COVID-19. And if I think about what I've been doing for the past month and a half, it's been talking about COVID-19. As it has been for a lot of people, and really kind of trying to dive into what are the financial reporting implications of the various matters that are arising as a result of this disruption to the economy, and it's been interesting to say the least. when I think about some of the issues that are emerging, in many cases they're not issues we've ever seen before. In many cases, issues we never even thought of before, and really, I think when we have our conversations either internally at BDO or externally with standard setters or with other member firms of the global BDO network or others in the industry, it's they're experiencing the same thing. The issues that are arising are complex and difficult to address. And the other thing that's really telling about how complex it is, every time we have one of these discussions, someone brings a new issue to the table, and when you look at it, you think, well, that issue is broad. It impacts a number of entities. So that is kind of what we're dealing with from a financial reporting standpoint. And when we think about the solutions to these issues, there isn't a guidebook. There isn't. There's nothing that says in this case do this. Everything will be dependent on an entity's facts and circumstances. So when I think of the playbook we as auditors need to use in dealing with the issues that are arising as a result of COVID-19, it really comes down to the basics. Really, the basics of how we attack any complex issue. Planning is critical, and making sure we're identifying all the accounting and auditing issues at the planning stages. Making sure you have the right team members with the right skills assigned to deal with these issues. Supervision and review has never been more important because, especially, for those of you on the line who have more experience, we probably have never experienced anything like this. I don't think anybody on the line was practicing when the Spanish flu hit. But that experience and the things you've seen are really important. Consultation is critical. Consulting within your own offices, consulting within your CCOLA network, reaching out to others in the industry that you reach out to regularly, whether they be individual experts or reaching out to some of the firms. Consultation to deal with these issues is critical, and just planning for things to maybe take a little bit longer than they've typically taken, and really coming down to, the other thing that's just really important is just people management and really understanding that everybody is quite stressed about these situations, whether it's your audit team, whether it's the entity, the people at the entity you're auditing, and just taking all that into consideration because it all impacts the audit. So, what are the issues at March 31st? And I'm sure there's more issues at March 31st than we're going to address, but these are the ones that we think are the big ones. So I will turn it over to Dave to start walking us through some of these.
Okay, thanks, Armand. March 31st is sort of seen as a key cutoff date for the COVID-19 issue. There were a couple of very key sort of events or date markers that happened in March. The WHO declaring a worldwide pandemic on March 11th, and a number of significant shutdowns across economies in various provinces in Canada and around the world. So, when we're dealing with December year ends or that kind of thing, a lot of the talk has been about subsequent event disclosure because most of the events have occurred subsequent to December 31st. But when we move to March 31st, we're now talking about events in the period. However, there's going to be judgment involved here. It will depend on some of the service offerings and operations of individual organizations. So contrast activity in areas such as tourism versus maybe online services. While this might be a high-level assessment that people are doing, I think we need to also be conscious of the dates and how they relate to even specific financial statement areas. So considering the timing of certain events and how that relates to judgments, estimates, specific financial statement areas. So for instance, take an example of an entity that, in March, some of the provinces introduced lists of essential businesses that could remain open. But then in April, that list was revised. So, which bucket does an organization fall in? Another example, certain aid packages have been announced by the government in March. Some of those passed through legislation. Others had not yet been passed, but got passed in April. So if government incentives or other things like that are part of the financial statement area of the organization, whether it was in March or April may make a difference for that particular financial statement area. So there could be different events, even for a single business, that will bridge the line between a subsequent event or something that happens in the period. The other comment to note is, it's going to be very difficult not to apply hindsight. So, we're sitting here today with certain knowledge of things that happened in April, and we'll get more knowledge as May goes on. But when you're doing an audit at March 31st, the events that took place at March 31st are the things that should be considered. So each organization will need to look at its operations, its services, its individual financial statement areas, and match that up with the dates of events that affect those specifically. So let's talk about subsequent event disclosures. So a lot of the talk about subsequent event disclosures is around December 31st year ends. And when we talk about March, we're going to be talking a lot about events that have already happened. But we got to make sure we don't forget that there are still subsequent events for March 31st year ends. So although we're going to concentrate on in this presentation, and you're going to be concentrating in your preparations and audits and things on things for March 31st, there is still subsequent events taking place, and those will continue to take place, throughout the rest of 2020. So, there still is a subsequent event disclosure piece that needs to be taken into account. And the longer the time period between the year end and the approval date of the financial statements, the more subsequent events might need to be disclosed and the more detail that may need to be provided in those disclosures. When we were doing December year ends, some of the financial statements and audit reports that were issued in late February or early March, they may have had very limited disclosure in them. But the ones that are happening in late March and early April and mid-April, those have much more robust disclosure. So we should be thinking along those same lines no matter what the year end is in 2020. Another very hot topic, of course, going concern. This area is also getting a lot more attention this year. In IFRS, we have to remember there are two requirements for going concern. And the first one we often skip. It doesn't even come onto our radar that often. The first one is that an entity is required to prepare financial statements on a going concern basis unless they plan to liquidate or have no realistic alternative but to cease operations. We may, in fact, see some more of those. So let's make sure we don't forget about that very first criteria. The second, much more familiar, is the disclosure of material uncertainties, events, or conditions that may cast doubt on the ability to continue as a going concern. We do expect there to be a lot more cases of these. And even if there is a determination by the entire team involved that maybe it hasn't hit that criteria of disclosure of subsequent event indicators, there will be many of those that will be considered quote-unquote close calls. And so I think there also needs to be consideration of whether those close calls should be disclosed as significant judgments in the financial statements. So even though the going concern disclosure may not be in the statement, if it was a close call, that probably elevates to the level of a significant judgment that would require disclosure in the statements under IFRS. We would expect that management and auditors will both apply more skepticism to things like cash flow forecasts, management plans. That might involve more downside scenarios being considered, more stress testing of cash flow forecasts and things. Again, the longer the time gap between the year end and the authorization of the financial statements, the more information that needs to be considered, which may actually be a plus as well as a potential negative. There's more information in hand to know what those first month or 2 months look like. So again, consider that for the going concern piece. Auditors, don't forget, if there is going concern disclosure, there are modifications to the audit report. in that section of the audit report on going concern. Another area of consideration is classification on the balance sheet. So this is whether an asset or a liability is classified as being current or long-term. We need to consider the criteria. Keep in mind that the criteria for classification of assets is different than liabilities. Assets is more about expectation. However, liabilities are very focused on the rights of the entity that exist at the balance sheet date. Subsequent happenings, subsequent events, are non-adjusting subsequent events in this particular area. So a covenant violation that exists at March 31st, where the entity gets a waiver after year end, the presentation is based on the covenant violation. The waiver that's received does not modify the classification at the March 31st year end date. However, maybe that waiver is a non-adjusting subsequent event that requires disclosure. We should also be considering any payment deferrals that might take place. For instance, let's say that an entity gets a three-month holiday on making payments on a particular liability, and those payments are added to the end of the instrument. Again, what is the current versus long-term amount for the upcoming fiscal period? So consider that as well. So then again, the knowledge of specific dates of events versus the entity's year end of March 31st will be important for the IFRS treatment of current versus long-term. Now perhaps one of the biggest areas of angst for files in general is the area of impairment. Impairment is going to be a significant issue at March 31st, and it will likely be an issue at June 30th, September 30th, and even December 31st. However, the challenges at March 31st will likely be the most difficult to deal with because of the amount of change, the pace of change, and the amount of uncertainty. Hopefully, we start to see resolution to some of this as we continue on into June, September, December. However, March 31st will probably be the most challenging at this point. In Canada, we've been applying IFRS since 2011, and since that time, it's been generally a pretty reasonable, healthy economic environment, generally period of economic expansion. So there may be many entities that have not had to dive too deeply into the impairment standards of IFRS. So to be clear, the impairment standards in IFRS, IAS 36 in particular, applies to all assets not covered by another standard, okay, like inventories or financial instruments. So all assets not covered by another standard must be assessed for indicators of impairment at every reporting date. I'll say that again. All assets not covered by another standard must be assessed for indicators of impairment at every reporting date. In the past, this was probably a very high-level assessment, quick and dirty, back of the napkin, a few points, and then moving on. Here we're talking about capital assets, amortized intangible assets, investment properties carried at cost, big stuff on the balance sheet. Something to keep in mind, goodwill and non-amortized intangible assets generally require a mandatory annual impairment test under IFRS, so people are used to testing those once a year. There is a very small exemption that is available for entities that have significant, what we call headroom, or significant difference between the last impairment assessment and the carrying amount, where a downward adjustment would have to be very, very significant for there to be any impairment. However, that's a very narrow scope exception. The key to remember is that even for goodwill and non-amortized intangibles that have an annual impairment test, they are still required to do an indicators investigation at each reporting date. And if there are indicators, that impairment testing must be done earlier. So we could have situations where impairment testing of goodwill and non-amortized intangibles is not just the annual test, that there's a test that needs to take place at March 31st and maybe even quarters in the year. So what does this mean for March 31st? When we look at the indicators, it's going to be very difficult to suggest that there are no indicators at March 31st, 2020, except for some very rare specific industry cases. The things that are at largest risk of potential impairment are things that have been acquired more recently. They will not have a lot of headroom for downward adjustment. So recent acquisitions in the last year or two, those ones are most at risk for potential impairment. We also need to keep in mind the inputs, the key inputs to impairment calculations. Impairment is assessed by comparing book value to one of two numbers, fair value less cost to sell or value in use. Think about fair value less cost to sale. What are we seeing in fair values during COVID-19? What's happening in the marketplaces to fair values? There's fewer transactions. Markets are stalled at best and down in many cases. So fair value less cost to sell, maybe a very good chance it's a smaller number. What about value in use, discounted cash flows? What are the projections of near or midterm cash flows? Any decreases that are going to happen there? What about discount rates? We hear from our valuation experts that discount rates are increasing. So a decrease in potential cash flows combined with an increase in discount rates, again, potential for decreases in value in use. So if there's not a lot of room between the book value and these fair value measurements, impairment is front and center. What are the indicators of impairment? Well, IFRS provides us a list of some of the indicators. It's careful to mention that it's not an exhaustive list, but there are a number of key ones here. You'll see in our materials that there are some here that we've underlined. We've added this emphasis to sort of point to ones that may be very difficult to overcome in the current environment. So, it may be very difficult to argue no to significant changes in the market or economic environment. Market rates of return on investments have increased during the period. Again, our valuations people are telling you generally across the board, this is what we're seeing. Internal sources of information. Performance of assets. Are they expected or will be worse than originally expected? Again, indicators. Let's go to the next slide. We're on slide 14, for those of you following not in the online version. Some other indicators. Again, internal reporting. Net cash flows differing from budget. Significant declines in budgeted future cash flows. Again, indicators that are going to be very widespread and common across many entities. So what does this mean? Well, just because there's indicators doesn't mean that there's impairment. But what it does mean is that a calculation is required. So if there are indicators, now a test has to be done. That's a comparison of fair value to book value. IFRS does allow reversals of impairments, so that's some silver lining maybe. That may come in the future, depending on how things go for the rest of 2020 and forward. Keep in mind that the amount of the reversal is limited to the amount that would otherwise be presented for the amortized cost. So it may not be a reversal of the entire original impairment, but only back up to what would be amortized cost at the date of reversal. The one big caveat to mention here is reversals does not apply to goodwill in IFRS. Under IFRS, you are not allowed to reverse an impairment to goodwill under any circumstances. Even in interim reporting, if an entity identifies an impairment in goodwill in one quarter, they are not allowed to reverse that in a subsequent quarter within the same fiscal year. There's an IFRS interpretation that deals with that, IFRS 10, and it specifically deals with that issue. So the messages here are a bit gloomy regarding the possibilities for impairment, but this is an area that has to be top of mind, front and center for entities and for auditors. With that, I'm going to turn it back to Armin, who's going to continue to talk about some nuances of impairment.
Yes, thanks, Dave. I get to do my best impression of an economist right now, and I've talked to this slide in a number of presentations, and the original version of this slide said most economists are predicting a V. This version says many economists are predicting a V. My most recent version that I'm working on for another session just says we don't know if it's going to be a V, U, W, and we all hope it's not an L, as far as the shape of what the recovery looks like. And why has that changed? And I think in the early days when most economists were predicting a V, they basically said, well, what are we dealing with? We're dealing with an underlying shock to the economy, but business models are not generally flawed, which is significantly different than what we dealt with in 2008, when the crash was caused by really a flawed business model in how subprime lending was being packaged as very high quality debt. And that wasn't the case here. But I think now that we hear, people are looking at this and thinking at it a little bit differently, is although the business model wasn't flawed going in, the question is it flawed coming out? And I'll use an example that might be related to some entities that some of you might audit in your roles. Let's think of train services, passenger train services. The cash forecast, the business model are based on hitting certain capacity levels. Well, what do those capacity levels look like, even as we open up the economy, but are still practicing some aspects of physical distancing? Well, all of a sudden, the number of riders on a train are going to be significantly less than what they were before, and that may be the case for an extended period of time until a vaccine is available. So when we look at the economy, so that's why a lot of people are changing their mind from it being a V, which is kind of the straight drop and come straight back up, versus a U. And then the people that are now starting to talk about a W-shaped recovery are those that are worried about a second wave and maybe a second wave of lockdown at a certain point. And we all hope that doesn't happen, but these are things that people are considering. We all hope it's not an L, because an L is basically a drop with no recovery. So what does this mean? And again, economists changing their predictions all the time. A couple of weeks ago, the IMF came out with predictions for all economies, and I think it said something like Canada was expected to have like a 30% decline in the second quarter, an overall decline for 2020 as a whole of about 6%, and then continued recovery into 2021. 6% decline in GDP for a single year is unprecedented. In 2008, the 1 year decline in GDP for Canada after the financial crisis was 0.1%. Therefore, basically the entire thing recovered within the year. This is the predictions right now are this to be a lot deeper if we're looking at a 6% decline for 2020 as a whole. That being said, there are some sectors that say, yes, I have to shut down. Yes, there's going to be a drop right now, but ultimately it's just a delay in my long-term cash flows. That's something we're hearing in the mining sector as an example, because the minerals will stay in the ground, and then ultimately the cash flows will come out. What does this mean for us as auditors? It means estimation uncertainty has never been higher. There's still so much we don't know. The provinces are all talking about their plans to open up, but really we don't know the full extent of the decline in the economy. We don't know the slope of the recovery, and then that slope of the recovery will be different for industry. So when we think about impairment tests, and what we have typically seen done with impairment tests is basically an entity will come up with a best estimate, and then we'll build some of the uncertainty into the discount rate. We're not sure that works with the level of uncertainty that exists right now. We're recommending that people do multiple cash flow scenarios to address the estimation uncertainty, and then weight those cash flows in coming up with the expected cash flows. The other thing that's absolutely critical whenever estimation uncertainty is high is the disclosures related to estimates and judgments need to be transparent and robust. The disclosures around this should increase substantially, whether they relate to assessing whether there is an indicator or not, or if there is an indicator, what went into the estimate. So now if I move to slide 17, just a picture of what we're talking about with the multiple scenarios. And you can actually see, like, if we're talking about a V, which is scenario 1, which is positive case, if the line of where it was, kind of kept on going in this graph, you would see that it eventually joins up again. And that is the best case scenario, that we're just kind of pushing cash flows out a bit. But then you have worst case scenarios, and you'd weight these and figure out, you'd make an estimate on what you expect to happen. And then the other piece of it, other than the cash flows, is discount rates. And discount rates are moving for various reasons. So we know central banks are lowering rates, but what we're observing is credit spreads are increasing significantly. We're also seeing the risk adjustments just due to uncertainty increasing substantially, and the credit spread increase and the risk adjustment increase is much greater than the drop in risk-free rates. So therefore, the rate is increasing. So even if I go back to my best case scenario, where the only thing this does is push my cash flows out, well, if I push cash flows out and I increase the discount rate, well, that results in a lower present value. That lower present value results in a lower recoverable amount, which increases the probability of impairment. The other thing to be really careful about, though, and this is where I think the valuation expertise becomes critical, is we're saying on that previous slide that you should look at this and say, I need to probability weight cash flows and build that uncertainty into my cash flows, where the typical approach has been prior to this has been build uncertainty all into the discount rate. There needs to be care taken that you're not double counting risks. And, because you're probably going to still have to adjust the discount rate because the uncertainty is so high at March 31st that it would be impossible to build enough cash flow scenarios and probability weight them enough such that you're gonna incorporate all the risks. So you're probably, even though you're probability weighting cash flow, you're probably still going to have to make a risk adjustment to the discount rate. And this is where a valuation expert can make sure that we're not double counting things to result in an impairment that is larger than it should be. This is all the accounting. Then from an audit standpoint, Dave, did you want to comment a little bit on CAS 540?
Sure. Yeah. Thanks, Armin. CAS 540, obviously dealing with audit of estimates, isn't just dealing with impairment. It's dealing with any estimate. But again, this is an area where we will likely see an increase in the requirements for audit. It'll be important for us as auditors to understand the criteria and the assessment of an estimate becoming one that has a high degree of estimation uncertainty, because there are different requirements for an estimate that's a high degree of estimation uncertainty. As Armin mentioned, we anticipate many of these estimates previously maybe weren't considered to have high estimation uncertainty, now may have that. In addition, we need to understand when those elevate to be a significant risk of material misstatement, because CAS 540 has very specific requirements. When there is high estimation uncertainty and significant risk of material misstatement, there are additional audit steps. There is also a heavier level of professional skepticism that needs to be brought to that. This is going to be the auditors having to do stuff, and it's going to be the auditors pushing management of the entity to do more work. They are going to have to do their own assessment in a more robust nature. Keeping that independence in mind, management is going to have to do their part. We may be into areas that require expertise, and those expertise may not be on the team. So auditors will have to think about, is there someone else in my organization I need to bring onto the team, or do I need to even reach outside the organization to an external expert to help me out with this particular estimate area. And management may need to do the same. So think about those reach outs. The other thing just to keep in mind that CAS 540, there is a new CAS 540 standard. It's not applicable until December 2020 year ends, but keep that in mind going forward. There'll be a new standard to get ourselves familiar with, as well as the existing 540 for March 31st, 2020 year ends.
Okay. And just so everybody's aware, we're not leaving the topic of estimates anytime soon here. Because the other big area that we talk about in IFRS related to impairment is IFRS 9 and the expected credit loss model. And we do have a few slides in here, and I'm on slide 20 right now. That it provides a recap of the model under IFRS 9. And I'm not going to spend too much time on it, but basically you have the three stages, right? The stage 1, there hasn't been an increase in credit risk. Stage 2, there's been a significant increase in credit risk. And stage 3, when it's been credit impaired. So obviously there's going to be quite a bit of issues related to IFRS 9. Because there's a lot of questions. A lot of people are out of work right now. Businesses are shut down. As a result, entities are facing, various entities are facing liquidity issues, and does that increase the credit risk and move something from stage 1 to stage 2 or all the way to stage 3? When we look at the model in general, we're always looking at what's the probability of default. Once we say that, then once we look at the probability of default, we then say, well, what is the loss given default? What are they going to lose? And it's the combination of those two things that leads to what the expected credit loss that should be recorded. And again, does the probability of default increase because of the scenario that we find ourselves in? How does it tie into the loss given default? And even with, and even how does this tie into government incentives, and do some of those government incentives maybe limit some of the losses that will arise? So all things that need to be considered, very complex to say the least. In addition to the very complex model within IFRS 9, there is a simplified model. This simplified model is really dealing with for trade receivables, and that you just basically avoid stage 1. You're always in lifetime losses, and rather than having to consider the 12-month losses. And I think when I look at our audience today and think about the entities that you audit, you're going to have entities that are very much like financial institutions, are financial institutions that are going to be following the full model, and then you have commercial entities that are going to be following the simplified model. But what we're finding is, regardless if you're dealing with a complex model or dealing with a simple model, the issues are actually very similar. Because what we're finding, and this has been kind of one of the most interesting things in the discussions that I've been part of, especially globally, related to IFRS 9. And I'm on slide 23 right now, and I'm going to start on the right-hand side of slide 23 instead of the left-hand side. When we look at entities that actually have complex models, entities that, you think about some of the global banks, some of the large banks in Canada, they have very, very complex models on how they're estimating probability of default, loss given default, all of those things. What those entities are saying is these complex models they built can't handle the shock that COVID-19 has created to the economy. So what are they doing? They're continuing to use their existing models, but then making an overlay adjustment. So making a judgment and saying, okay, this is what my model's saying, but my model doesn't, we're in a really unprecedented time, so I'm going to make a judgmental adjustment. That is the exact same thing entities using a simple model are doing. When I think of a lot of our commercial clients that we have, most have used what I will call a historical loss-based model. And they've used an overlay of saying, okay, what do we expect to happen in the economy for forward-looking information? And because, as Dave said earlier, we've been living in this very stable economy, that adjustment for the forward-looking information has been relatively minor, if there's an adjustment at all. So when we look at whether you're using a simple model or a complex model, there is going to be a lot of judgment that goes into this overlay adjustment. And that, when I think of things that are going to be difficult to audit, it doesn't get any more difficult to audit than a very subjective adjustment. So that will be a huge challenge for people. The other thing just to bring up with this is the other thing that why some of these models aren't working is, within the standard, within IFRS 9, there is a 30-day and 90-day rebuttable presumption. So if something's overdue by 30 days, there's a rebuttable presumption that there's been a significant increase in credit risk. If it's overdue by 90 days, a rebuttable presumption that it's credit impaired. Right now, if you look at what's happening, a lot of people are deferring payments. So, and even for entities that they don't think there's a significant increase in credit risk, they're deferring payments just because of the unusual circumstances we find ourselves in. Therefore, do the 30-day and 90-day rebuttable presumptions still work? When we look at the simple model, basically there's an example in the standard that says you can use basically an aging matrix to come up with your ECL. Well, do the time bands in that aging matrix, are they still appropriate given some of the loosening of credit terms that is taking place right now? So this is going to be very subjective and difficult to audit. So with that, I actually think OSFI has put out some really good guidance on what they are expecting from the entities that they regulate. And really what I want to focus on here is that disclosure is critical. It's all about disclosure, whether we're talking about impairment under IAS 36 or talking about IFRS 9. Sufficient disclosure allowing users to understand the judgments management made related to COVID-19. Transparency about the uptake of deferral programs and how forward-looking information, economic forecasts are being incorporated in, and how those forecasts have changed since the last time an assessment was done. And then just also, it's not as easy as saying, oh, we have all these entities deferring payments. They must all have a significant increase in credit risk. It's not that simple. It was pointed out to me that there are some entities that are actually doing very well, taking advantage of deferral programs because it might be more effective for them to deploy their cash elsewhere versus the extra interest they will be incurring because of taking these deferral programs. So all of this needs to be considered, which is going to make IFRS 9 difficult to deal with for auditors. So other estimates to consider, and there's plenty of them to consider, inventory, impact of inventory sitting on shelves, obsolescence, expiry, supply chain issues. I was actually having a really interesting conversation with someone, last week actually about cannabis, something that a number of you might have to, audit the provincial cannabis entities, and that the longer something is sitting on the shelves, although still can be sold and still there isn't quality issues, the longer it sits on the shelves, the price drops as it sits on the shelves because the consumer wants a fresher product. So, how does that impact net realizable value of inventory? And that's just one example out there. The other one that is quite problematic at March 31st is investment property. This is property held for capital appreciation or rentals. There's a policy choice, measure at fair value or cost. Right now, basically at March 31st, appraisers are qualifying their reports because there is not enough transactions happening in the market for them to observe what the capitalization rates are right now on investment property. So how does that impact the fair value adjustments that are needed to investment property? Revenue, again, there's a lot of things in revenue recognition that are based on historic results, variable consideration created by refunds, returns, and price concessions. Given the environment has changed so drastically, can we really rely on historic results as an indicator of the future, and how does that impact revenue recognition? So all sorts of estimates to consider. The other thing, discount rates. I think when I read IFRS standards, there's very few standards that do not make reference to discount rates. And they all use discount rates differently. So when we look at AROs, or asset retirement obligations, are typically measured using a risk-free rate. As I mentioned earlier, central banks are lowering rates, so risk-free rates have dropped significantly, which will increase the value of AROs. But leases, the opposite is going to happen. So, if you're applying IFRS 16, the incremental borrowing rate you determined for a lease that was entered into in December is going to be significantly different than a new lease entered into in April or May because of the increase in credit spreads and therefore impacting the discount rate. Employee future benefits, another one where there's issues. Because we look at the discount rate is based on high quality bond rates. High quality bond rates are moving as well. There's also a lag because high quality bond rates are typically anything AA or above. There's going to be a lag between the credit agencies and other things. So will there be, there's even a question of whether there's enough high quality bonds to do so. And then just like onerous contracts or another area to consider where there's estimates. So just estimates everywhere.
So I think, we've listed off a number of areas that people need to consider. We obviously haven't hit everything, and it's overwhelming. I mean, even just preparing and for this presentation is overwhelming when I start to think about the clients that I work on, and I'm preparing the presentation. As start to get some cold sweats about some of the stuff that's coming down the pipe here. The recommendation, I think, is to really step back and just take a very methodical approach to things. Get out the financial statements from last year or Q3 and just go line by line. Start with a statement of financial position, balance sheet, line by line. Start, cash, AR, inventory, whatever the line by line. Pause on each one. Okay, what's going to change here? Think right down to the assertion level. Valuation, existence, completeness. All of the assertions for each of the areas. Think about the changes. Think about sort of supply side as well. A robust discussion with management and auditors. Make sure everybody's on the same page. Some of these areas might require new or different reports. The client may not be ready for producing some of this information reports. That's going to take time. Consultations, using experts, those are all going to take time. If significant progress has not already been made in these areas and planning for these areas, you need to start that now, like this afternoon or Monday. You really need to get on it because there will be time delays in getting some of this done. Beyond March 31st, going to slide 28, there are some effects that are going to linger. We've listed some here on the slide. We're not going to talk about each one. Some of these will involve legal opinions like the impact of force majeure clauses. The most important sort of box on this slide is more issues will emerge. I don't think we've seen the end of issues, and no doubt there'll be a request for another session at some point down the road. Is there any silver lining here? Well, I guess those who are looking for a little bit more variety, exposure, and challenge, tackling issues, I think your day has come. Slide 29, we have a list of some resources that we have available. We're putting up new resources every day, every week. Please feel free to access these areas, available in English and in French. Armin and I have both provided our contact information here just as an initial contact, slide 30. And feel free to reach out to us. But of course, we have lots of professionals across the country that we can put you in touch with to also assist you with any questions, discussions that you have. So I think that's our official presentation. I think, Armin, we're going to do some time for questions now.
Yes. So a couple things just maybe before we get to questions, and I don't know if we have a lot of questions, but there's still time to submit your questions if you have any. For a couple things just logistically, we are recording this session. It will be available next week along with the public sector one we are doing next week as well. For all that registered, they will get a follow-up email which will have a link to where the recording is posted. So if you have some colleagues that were unable to attend and feel that this is worth sharing, please feel free to send that link on to them. For those of you that are with the OAG, the federal OAG, we have been working with your HR people, and we will be sending the registration list with OAG people to Catherine so that you can get credit in your LMS system. And Sona, do we have any questions? Sona, I think I assume you're on mute.
How's that, Armin?
That's
is that
much, that's
you hear
much
me now?
better, yes.
Yeah, it's always nice when the mute button is off, right? So we have a couple of questions that have come in. Dave, the first one is for you, and it's a materiality question. So the auditor writes in that they have started to plan a March 31st year-end file, and it looks like the current year materiality has significantly increased from the prior year. So the question is, should they just keep using the previous lower level of materiality in the current year to avoid a prior period adjustment issues next year, because they are expecting the COVID implications will have a much more pronounced effect?
Wow, great question. Yeah, we've been having discussions at BDO about that issue as well, and that sword is going to cut both ways, increases and decreases in materiality. Some of the discussions that are going on now are issues like, can we normalize? Say we use revenue or income from operations as a basis for materiality. Can we normalize it for COVID-19 effects? Possibly. I think the caution there is, what is normal? How much of the changes in the past year or in the following year are related to COVID-19 and one-off, and how much of it maybe is from just regular changes in operations? Or what does the new normal look like? So I think you have to be cautious in doing that type of thing. You may need to look at other bases aside from just an income or revenue base. There's talk about using averages as well, but again, you need to be cautious there. I think it's an area of judgment. I think each team is going to have to look at it and come up with an answer that makes sense for the entity. The other comment is, materiality is all about the users. What's important to the users? We also have to think about, maybe there's going to be a different set or additional users of the financial statements this time around. Maybe there's additional lending that's being sought. Maybe there's a new legislative requirement such that there will be a different set of users or additional users. And what's going to be important to them? Do I maybe need to temper the materiality because of that? So I think, planning the audit, starting right from the top at materiality, is going to be a consideration. I think there are going to need to be adjustments, but they are going to have to be case by case. I don't think there's going to be any sort of set rules on how that's going to work. I know that's not a clean answer, but I think it's the answer of the day.
Okay, thanks so much, Dave. Armin, the next question is for you. And we hear that provinces are starting to open up. We see the numbers kind of flattening. And so if economic forecasts hold true, do you expect to see a lot of impairment reversals in the third and fourth quarter, or even into fiscal 2021? And if you do, how would you go about accounting for those?
I really hope there's going to be reversals. I think at the end of the day, other than, as Dave mentioned, other than goodwill, under IFRS, impairments do reverse. And regardless of the shape of the recovery, whether it's a V or a U or a W, that should result in reversals of impairment. Some of it's depending on the industry and depending on the facts and circumstances where impairments occur, it might take longer to experience those reversals than in others. And so I really hope for reversal. And I think what ends up happening in these scenarios, and this is where it gets really challenging, is regardless if you just report annually or just report quarterly or report quarterly, you have to remember that you're always looking if did the factors that led to the impairment, have they changed? So we look at what are the factors that led to impairment? Well, COVID-19 is the trigger, but the factors that probably have led to impairment are really the lockdown of the economy and the change in behaviors as a result of COVID-19. And if you think of something like the airline industry as an example, it is going to be some time before people get on international flights again, right? So do we hope that there's a recovery and in reversal of impairment? Yes, but for the airline industry, it might be significantly longer than other industries. But where I'm going with this is all along that line until it does recover, things will hopefully be getting better. And as they get better, and as behaviors change and go back to back to normal, that is part of the indicator going away. So that you're going to actually have to assess for reversal as the economy starts to improve more often than once. There's not going to be this magical day where everything's back to normal. It's going to happen over time. So if we look at this and say there's a reversal at March 31st, or there's an impairment at March 31st, 2020, well, there may be a partial reversal by March 31st, 2021. And then we might get to a full reversal by March 31st, 2022. But at the end of the day, that assessment will have to be done multiple times until you get to the full reversal.
Thanks, Armin. That's pretty timely since the Premier just announced that garden centers, landscaping, and auto dealerships are resuming on Monday. So we don't see any more questions. So, Armin, did you want to wrap this presentation up then?
Yeah. Again, thank you, everyone, for joining. Hope to see all of you and others on our public sector accounting standards session next week. One last logistical thing. If my email address is in the slides. For those of you who did call in, and therefore we don't have that you've attended in the WebEx system, just whip me off an email, and so that we can then match up the registrations to the attendees, so that we can, especially those of you that are with the federal OAG, so that we can get that information for your LMS system. And with that, thank you very much, and have a great day.